Welcome and thanks for joining this session on commercial bank loan products. In the next few minutes, we will explore the main types of financing available to businesses, why each exists, and how to match products to specific strategic needs using practical examples and simple frameworks to guide decision-making for growth-oriented borrowers. Term loans provide a lump sum capital injection with a fixed repayment schedule, making cash outflows predictable over time. The slide's diagram shows how installments translate into a final payment and why these loans align with long-lived assets like equipment or real estate, supporting expansion while matching debt tenor to asset lifespan for better asset liability management. Lines of credit offer flexible, revolving access to funds where interest applies only to amounts drawn. Think of it as a financial safety valve for seasonal cash flow shortfalls, inventory purchases, or short-term operations. The circular diagram illustrates draw, repay, and replenish cycles, while the interest column highlights cost only on utilized capital, keeping working capital efficient. Real estate and property loans are tailored for owner-occupied and investment properties, typically featuring longer amortizations and lower rates. The underwriting flow on the slide highlights property, cash flow analysis, and debt service coverage ratios as core inputs, emphasizing sustainable property income and debt coverage as key determinants of credit approval and long-term viability. Government-guaranteed SBA loans expand access to capital for small businesses by offering low down payments, extended terms, and flexible eligibility. The slide links common funding uses equipment, working capital, and real estate up to established limits to strategic benefits like government-backed guarantees and support for business expansion, making larger or longer-term investments more accessible for growing firms. Equipment loans and invoice factoring solve different funding gaps. Equipment loans let businesses use purchased assets as collateral, preserving working capital and enabling technology upgrades, while invoice factoring advances cash against receivables to accelerate cash flow and bridge long payment cycles. The comparative table underscores how each product protects liquidity in distinct but complementary ways. Syndicated loans pool capacity from multiple banks to fund very large corporate transactions, spreading risk across institutions, as shown by the diagram of lenders contributing to a single facility. Mezzanine financing sits between senior debt and equity in the capital stack, offering a hybrid tool to bridge funding gaps when senior leverage is exhausted, usually at a higher return profile. The Strategic Loan Evaluation Framework walks decision-makers through aligning loan purpose, repayment ability, collateral quality, and total cost and terms to reach an optimized financial solution. By defining the capital need, assessing cash flow capacity, evaluating pledged assets, and analyzing fees and covenants, lenders and borrowers can select a cost-effective structure that supports operational flexibility. Turning loans into growth enablers starts with a clear and repeatable approach. Map your growth plans, quantify funding needs, compare suitable products, prepare robust financials, and engage potential lenders early. This sequence helps ensure the chosen financing aligns with strategic objectives and timing, improving the odds that credit solutions will actively support, rather than constrain, business growth.